For decades, investors were told that passive investing was the safest long-term strategy. Buy the index, hold consistently, avoid emotional decisions. Over time, trillions of dollars flowed into index funds and exchange-traded funds tracking broad markets. The strategy appeared rational. Passive funds offered low fees, diversification, and strong historical returns. But as passive investing grew larger, markets themselves began to change. Today, massive amounts of capital move automatically into companies based not on valuation, profitability, or strategy, but simply because those companies are already part of an index. This raises an uncomfortable question. What happens when price-insensitive investing becomes one of the dominant forces in financial markets? This is the story of passive investing and how a strategy designed for stability may quietly reshape market behavior itself. Passive investing refers to strategies that track a market index rather than attempting to outperform it through active stock selection. Index funds and exchange-traded funds allow investors to buy broad baskets of securities with minimal management costs. The idea gained popularity after evidence suggested that many actively managed funds underperform market indexes over long periods. For retail investors, passive investing offered simplicity and diversification. For institutions, it offered scalable exposure to markets at low cost. As assets flowed into passive funds, major indexes, such as the S&P 500, gained increasing influence over capital allocation. Companies included in these indexes attracted continuous inflows from retirement accounts, pension funds, and automated investment strategies. Over time, passive investing expanded from a niche strategy into one of the dominant structures in global equity markets. Passive investing promised efficiency and discipline. Rather than attempting to predict short-term market movements, investors could participate in long-term economic growth through broad diversification. The strategy reduced trading costs, minimized emotional decision-making, and avoided many of the risks associated with concentrated stock picking. The broader promise was market rationality. If investors collectively owned diversified indexes, capital allocation would remain stable and efficient over time. Passive investing also reinforced confidence in long-term investing behavior. Regular contributions through retirement accounts and automated investing programs created continuous demand for index products. As flows increased, markets appeared more resilient. Volatility often remained lower than expected. Liquidity improved. Large companies attracted steady investment regardless of short-term uncertainty. This stability strengthened the perception that passive investing was not only safer for individuals, but beneficial for markets overall. The assumption underlying this promise was that active investors would continue setting prices efficiently, while passive investors simply followed. The rise of passive investing accelerated dramatically after the global financial crisis. Low-cost index funds consistently outperformed many active managers after fees. Investors shifted capital away from traditional stock-picking strategies toward automated index exposure. Technology amplified the trend. Online brokerages, retirement platforms, and robo-advisors made passive investing accessible to millions of participants globally. At the same time, central bank liquidity and low interest rates supported broad asset price appreciation. This environment favored large-cap indexes heavily weighted toward dominant technology and growth companies. As passive funds accumulated assets, their market influence increased. Capital flowed automatically into index constituents regardless of valuation differences. The largest companies therefore attracted disproportionate investment simply because they represented larger portions of the index itself. This created feedback loops. Rising prices increased index weights, which attracted additional passive inflows, reinforcing price momentum. The rise of passive investing was not driven by speculation alone. It reflected rational responses to fees, performance data, and technological accessibility. But scale changed its systemic significance. Passive investing depends on active markets for price discovery. Index funds do not evaluate whether a stock is undervalued or overvalued. They buy securities according to index composition. This structure works efficiently when active investors continue analyzing companies and setting prices through trading decisions. The concern emerges when passive flows become dominant relative to active capital. If large amounts of money move automatically into indexes regardless of valuation, market pricing may become increasingly momentum-driven. Large companies can attract more capital simply because they are already large. Smaller firms outside major indexes may receive less attention and liquidity. This concentration can increase systemic sensitivity to a narrow group of companies. Another vulnerability involves liquidity during market stress. Passive funds offer investors daily liquidity, but some underlying assets may become difficult to trade during volatility. If investors sell index products rapidly during downturns, funds may need to sell underlying securities simultaneously. This can amplify price movements. The structure also creates correlation. Assets grouped within indexes increasingly move together because they are owned through the same vehicles. Diversification may therefore appear broader than it truly is during stress periods. Passive investing itself is not inherently destabilizing. The vulnerability lies in scale, concentration, and dependence on continued inflows. The system functions smoothly while confidence remains stable and long-term participation continues. Stress test that assumption. A severe passive investing disruption would likely emerge during a prolonged market decline combined with broad investor withdrawals. Large outflows from index funds could force widespread selling across major equities simultaneously. Liquidity conditions might deteriorate quickly, particularly in sectors where passive ownership is highly concentrated. Price declines could reinforce additional selling through automated strategies and investor psychology. Active managers, having become smaller relative to passive flows, might struggle to stabilize pricing efficiently. The collapse would not necessarily destroy passive investing as a strategy, but it could expose how strongly modern markets depend on automated, price-insensitive capital flows. After major volatility events, markets typically reassess concentration and liquidity risks. Regulators may review market structure. Investors may diversify across strategies. Yet passive investing would likely remain dominant because of its cost advantages and long-term performance history. The system would adapt, but the underlying dynamic, large automated flows influencing markets, would persist. Passive investing transformed markets by making investing cheaper, simpler, and more accessible. Its success reflects rational behavior by millions of investors. But systems change when strategies become dominant. What begins as diversification can gradually create concentration. What appears stable during calm periods can behave differently under stress. Understanding passive investing therefore requires looking beyond individual portfolios toward market structure itself. Modern markets are increasingly shaped not only by decisions about value, but by automated flows of capital.